So Bitcoin, AI stocks, banking names, and pretty much all risk assets are now selling off by more than 10% off their 52-week highs. Essentially, Wall Street calls this correction territory, but it's really the market trying to tell you that the fundamental picture has changed entirely for these assets. So in today's video, we're going to cover why this is, what the market is trying to tell you, and look at this whole situation through a much more meaningful lens than just technical analysis. That being said, my name is Gabriel Osorio-Matsili. Welcome to Investor Brew, and I'll see you on the screen. All right, so the whole reason I made this video today is to let you know what is happening in the markets, right? What's really going on behind all of these sell-offs. And as always, before we get started, we have some housekeeping items to go over as it pertains to our WhatsApp deal room and some of the successful exits that we just had this week alone. Starting with Lazy Boy, ticker LZB. This is a stock in the retail home furnishing industry that I pitched right before earnings were announced. This was about $29.50 to $30 a share. And as you can see, it jumped to 37 and change, almost 38. So that's a pretty significant return of over 30% in over a couple of days. And then we also have the ongoing short position in Taiwan Semiconductors. If you don't know the thesis behind this one, don't worry, you don't have to be part of the deal room just yet. We made an entire video and newsletter post to cover this entire idea for you. Now, this might be the beginning of the AI trade unwind, or the AI bubble, if you want to call it that, popping. And while everyone's focused on Nvidia, AMD, Micron, and all those names, I think that Taiwan is the one that's going to be affected the most. If you're curious about that trade and whether there's enough room for you to enter and profit from it, then I invite you to watch that video right after you watch this one and get everything down for yourself. So let's get into today's topic. What is happening in markets? And as you can see in this chart, all the big tech names in the United States like Oracle, Palantir, Meta, AMD, Tesla, Netflix, Nvidia, Amazon, Microsoft, Broadcom, right? Pretty much the max 7 plus or minus 2 or 3 more stocks that represent the sentiment for data center expansion, AI, and everything that's big tech, right? But the reason I posted this is you can see most of them are into correction territory. In fact, 7 out of 10 are in bear market territory, which is essentially 20% or more off of 52-week highs. That being said, you can see that the top sell-offs have to do with AI directly, if not data centers. So essentially the market is becoming bearish. It's losing confidence in the future fundamentals of the entire data center revolution, the AI revolution, and everything that has to do with all the hype and overvaluation that's happening in this industry. So that sentiment shift is being seen around the S&P 500. As you know, it is overweight big tech, but we have to check some of the quote unquote technicals and see what's happening to the S&P 500 specifically. So when we get into it, we are not going to cover technical analysis or any patterns or indicators like that. We're going to use the tools that investment bankers and hedge fund traders use every single day in order to figure out what the sentiment is, how far it can extend, and what's the next reasonable step. And right now, you can see that volatility measures are reaching levels not seen since Liberation Day of April 2025. So essentially, we are in a level where the VIX could top, turn, and then turn the S&P 500 back towards the highs. If not, then we might see a further sell-off. Right now, we're about 12%, 8 to 12% off of 52-week highs. So essentially, it is correction territory. The market is trying to tell us something, but there's nothing we can do yet until we know what is happening and what the rotation coming next might be. And that is the entire purpose of today's video. So right now, we see volatility spikes, as I mentioned, and we also see volume spikes. So right now we have the highest reading over the past quarter, which means that nobody wanted to trade as much as the past week as the volatility measures started to spike. So essentially there is some action, there are some transactions happening right behind this price action. It's not just an empty price move, right? So with this, I want to touch on some of the macro environment and what's going on there, specifically the dollar, because right now the commercial positioning is at a net negative. So what this means is all of the commercial traders are in a net short position, and this hasn't happened more than 3 times over 2014. And every single time, as always in stocks and other assets, when there's too much short interest a short squeeze might end up being the net result. And right now in the dollar, I have several reasons to believe that the dollar might see some strength moving forward. We made an entire newsletter post about it, what's happening with the Fed, other central banks around the world, and why I think that the dollar might strengthen over the next coming quarters. Now, those shorts are going to come into pain because of this entire reason. So if the dollar squeezes those shorts and goes even higher, we are going to see some rotations out of speculative names like AI, Bitcoin names, and all other risk assets and back into defensive consumer staples and stocks of that sort. But before we get into those names, let's check what the Fed is trying to do. Right now, we have a 71% probability of a rate cut for December 2025. But the market isn't really reacting because the dollar rallied by 0.8% the week that these probabilities rose for the rate cuts, which means that the market isn't really buying that probability range anymore. There's really no reason for the Fed to start cutting rates when unemployment is going down and inflation is still sticky. If you cut rates now, it's just going to get a lot worse. And when it comes to employment, this time is a lot different than previous scenarios when it comes to employment, because right now it is more about policy than it is about monetary rates, monetary easing, quantitative easing or tightening, right? Right now we have an immigration policy, we have a labor policy that is affecting the employment and labor market more than monetary policy. So there's really little what the Fed can do about this entire situation, which means rate cuts aren't really that necessary at all because we have high inflation, we have low economic growth happening from a policy standpoint, not a fiscal standpoint. So when we move on, that rally in the dollar, despite the rate cut probabilities going up, says that the market isn't buying that whole narrative. But there's a way we can find an edge in this entire rotation and what is happening in the real economy, not the hype and AI scalar economy, right? So with this, we have the delayed jobs data, the NFP that we just got last week. Now, the number was okay. It beat expectations and the market was sort of bullish and excited about this whole thing. I'm not, for reasons we don't have to get into today. But right now we see a spike in jobs for retail trade. So that's essentially the consumer sector. And it's the foundation of the reasons why I'm turning bullish in that space for my portfolio. So with this, we can follow on and check other data points like the PMIs and other indicators for the economy that tells us whether the retail sector is going to keep expanding, whether it is expanding right now, and what we can do about it. So with the PMI readings, we can see that retail trade has been expanding since July, then August, September, and October. So pretty much a quarter plus an entire month of expansion continuously in the retail sector. So that should tell you that the odds or the probabilities of higher earnings per share reports are going to be high enough for you to make a profit out of certain companies that the market likes. That being said, over the past 2 weeks, we had retail trades within our WhatsApp deal room in the investor group portfolio, such as On Holding, Wingstop, and other names that have beaten earnings, have given us premium setups, and delivered 20% plus returns within 1 week for all members. You can get 7 days free right now in the link in our bio, and you can get access to all of our Excel models, valuation thesis, and everything that we put in for these plays given straight to you. You can cancel anytime, and if you choose to stay, trust me, you're gonna pay for years worth of a membership with one single play. Now that being said, let's go back to some other macro indicators such as the sentiment between growth stocks and value stocks. And you can see that through the IVE spread to IVW, which is value stocks over growth stocks. You can see that it has bottomed over the past couple of months without a rally in oil. So what you can take this as is the market is rotating back into value out of growth, and it is completely justified because there is no rally in oil. If anything, it is struggling below $60 a barrel. So essentially the market is telling you we see no economic growth expectations or reasons to believe there will be economic growth or additional activity. So the rally in oil is missing because of that. And you also see the rotation back into value out of growth. So that kind of makes sense. With that, you can go to the XLY or the consumer discretionary sector ETF in the market. also going down into correction territory, though it is recovering compared to the S&P 500, compared to the AI stocks, and even banking stocks. So that should tell you that while everything else is falling into correction and even bear market territory, consumer discretionary is beginning to recover out of this whole rotation back into value. So let me translate this. The market is telling you value is being found in consumer discretionary, but we have to be careful here. We have to find premium setups, if not turnaround names that have seen very little growth over the past few years and are now seeing the opportunity to expand on that EPS moving forward. That being said, we also see a recent interview from Goldman Sachs saying that they are bullish on the consumer discretionary because of three main factors. Right now, we have tax refunds incoming for the next 1 or 2 quarters. We have up to $60 billion in stimulus with a potential for $2,000 tariff dividend for each US citizen in medium to low income. Then you also have the DXY or dollar index strength, which is going to help the domestic consumption in this entire sector. So again, we have several macro and micro reasons to be bullish consumer names, but there's a specific set of names within this industry that are going to outperform. And there's only one way to find out, and it is to see where the money is going, where the market preference is shifting. For that, we can spread out all of the industries within the retail sector, and we can notice two things happening. First, the automotive, retail, and wholesale parts is trading at an expectation of 57.5% EPS growth over the next 12 months, while the average for retail is only 13.6. Despite this above average growth, we have a discount on the forward PE, as the automotive, retail, wholesale parts trades at 18.3 times compared to the average of 23.2 times. So essentially, this would be our turnaround opportunity as we have above average growth and below average valuation. So if you can find a premium stock in this space, I think that the odds for you to make money over the next couple quarters are pretty high this time. Then secondly, we have the retail discount stores, and this has me pretty excited as far as value opportunities because we have a above average, slightly not as aggressive as automotive, but above average EPS growth rate of 16.9% compared to the 13.6%. And we have a premium this time in the forward PE of 26.8 times compared to 23.2 times. So essentially, if we can find premium stocks that have the above average growth rate here, we also have a pretty good odd of making money. Keep in mind also that if the $2,000 dividend from tariffs payment comes out, all that money is going to be spent. The consumer is going to go back into confidence spending, and essentially all of these necessities in the discount stores industry is going to see a main benefit from it as well. For the automotive, we made an entire video about why Valvoline stock could be the outperformer or one of the outperformers in the space for reasons that you can find out in there after you watch this video. Now, having those two industries in mind, we can spread out the stocks and find the outliers that might be worthy additions to the portfolio. So let's do the retail discount names first. And we have Burlington Stores as an outlier. As you can see here, we trade at a 26.8 times forward PE compared to the 22.7 average. And that stock is expecting to deliver 16.9% growth versus 11% average. So again, that leaves us with a 1.6 times forward peg ratio compared to the average of 2.2. So in other words, the future growth in Burlington is not being priced in as of yet, and it is above average. Therefore, it commands a premium on the forward PE. So I think this could be a pretty good setup when it comes to a long position. If you're looking for a turnaround, we have Target stock as a potential winner here because growth isn't really there, but that could soon change as the business is making sort of the right moves going into 2026. And again, if we see the rising confidence out of the consumer and dollar strength, then Target might see some benefits into the coming quarters. Then for automotive, we have a stock like Advanced Auto Parts, and the reason I chose this one is not only because it trades at 74% of 52-week highs, giving you enough room of upside and enough of a margin of safety when it comes to downside limitations, but also because it is expecting to deliver 57.5% EPS growth over the next 12 months compared to the average of 22.7% alone. So that metric there is telling you all you need to know about what Advanced Auto Parts is looking to do over the next 12 months, which is why it also trades at a forward PE of 18.3, a premium over the average of 16.7%. The market is telling you, hey, we're looking to overvalue this stock for the right reasons, and that is growth. Now, on the forward PEG ratio, we have a 0.3 compared to the 1.0 average on the industry, which means this entire growth rate for the future is being discounted by 70%, which tells you all you need to know about your upside. Again, it trades at enough of a discount from the 52-week highs to deliver on this promise. Now, with that being said, we might choose to do this trade or express this idea through a long short equity portfolio, which is going to outperform as a strategy when it comes to volatile markets, when it comes to uncertainty in the macroeconomy, and the cycle of recession that we might be headed into for the United States. Now, if you're a long only buyer or you're interested in learning how to do long short equity trades, we made it an entirely free 5-day email crash course for you. You can sign up for it in the link below this video. Get your first lesson delivered to your inbox right now. And again, you can get your 7-day free trial for a WhatsApp deal room in the link in our bio, where we'll send you our entire financial analysis, valuation thesis, and hedging opportunities for these turnaround value stocks, and also the long short equity portfolios that we give you. So with this free education, plus 7 days free to implement those models and implement the tools that we give you, you're going to be aligned with these views into a dollar strengthening, into the AI trade unwind to protect your portfolio and have the volatility of your portfolio as well. With that being said, I hope you are beginning to understand where we are today in the S&P 500, how there's a lot more volatility in terms of room for it to move lower still and fall into correction, if not a bear market territory. If that's not going to be the case, at least you have an idea of where the upside is, backed by Goldman Sachs and backed by fundamental data. With that being said, I hope you got a lot of value out of this. Don't forget to check our socials. It's been an absolute pleasure, and I'll see you guys in the next one.